Hi all, welcome to this tutorial. So in this tutorial, we are going to cover the important topics, Introduction to Financial Statement Analysis. So this is our first lesson in the CMA USA tutorial video. So in this tutorial, we are going to cover the Introduction to Financial Statement Analysis. So this chapter coming from the second part from the CMA USA examination, and this is the first chapter. So before starting to financial statement analysis, the first thing we have to understand what is a financial statement or what are the important financial statements. So when it's come to financial statement, there are three important financial statements. The first one is income statement or what we called as profit and loss account. And the second one is balance sheet or what we called statement of financial position. And the third one is statement of cash flow, which is showing the cash inflow and cash outflow of a company during a period of time. So here the income statement, which is also called the profit and loss account, which is showing a company's profit or loss during a period of time. In the balance sheet, it is also called statement of financial position, which is showing a company's financial position during a point of time. Again, when it comes to statement of cash flow, which is showing the cash inflow and cash outflow of a company during a period of time. Though these three are the key important financial statements that used to in financial ratio analysis or financial analysis. So the financial statement analysis is the process of it's a systematic process of evaluating a company's past and current financial data to assess its performance, solvency, efficiency, and future prospects. So this is the process of evaluating companies' past and current financial data. So from where we can get this financial data? These three or the financial statement, from the financial statements, the income statement, balance sheet, statement of cash flow. Even there are other statement as well, like changes in equity, statement of changes in equity. So as a financial analyst, what we are doing, we are collecting financial data from this income statement or from this financial statement, and you are interpreting this data to meaningful interpretation, including the. So this data can be used for interpreting and providing meaningful interpretation for the stakeholders, which include managers, investors, creditors, and regulatory bodies. So these are the interesting or the stakeholders who interested in the performance of a company. So they can use that the financial data to assess the company's performance, solvency, efficiency, and future prospects. So as we understand now, the financial statement analysis is a process of evaluating a company's past and present financial data to meaningful interpretation. So who are the users of this interpret the financial data? There are different stakeholders are there, including managers, creditors, employees, regulatory bodies, board of directors. There are a lot of stakeholders are there. So these stakeholders are using this interpreted financial data to make various financial decisions. So let's move into the key objectives of financial statement analysis. The first one is performance assessment. As we said now, the financial statement analysis will help the companies to assess its performance, and it can compare with the standard benchmark or the similar industry standards. So the financial statement analysis, which help the measure profitability and operational efficiency to see how this company is performing. Then the risk evaluation. Financial statement analysis determine a company's ability to meet its short-term and long-term obligations. So the financial statement analysis help the companies to assess its short-term and long-term obligation and see how is the risk level of the company. Again, the forecasting. The financial statement analysis will help the companies to forecast its future expectation. It may be revenue or its operating profit, net profit, cash flow. So the financial statement analysis help the companies or the management to forecast its future data. So from the financial statement, so they can interpret the meaningful, or they can forecast by using the future earnings by using the old financial statements. Then the comparative analysis. Again, the financial statement analysis will help the compare a company's performance with the industry benchmark or peer companies. So if a company's return on investment in this year is, just assume it's 10%, and its previous year return on investment is 11%. So what it means that its return on investment is reduced. So the financial statement analysis will help to compare its financial results against the industry benchmark or its previous performance and its company standard. So we discussed now the key objectives of financial statement analysis. The first one is performance assessment, then the risk evaluation, and the forecasting and comparative analysis. So let's move into our next topic, that is comparative analysis. Comparative analysis, also known as horizontal analysis, is a period-to-period comparison of a financial statement item, typically spanning last 2 years, and it highlights absolute changes in dollar differences and percentage changes. So the comparative analysis or horizontal analysis is the comparison of financial statement data with the previous year or previous years. So in the horizontal analysis or in the comparative analysis, the financial statement preparing or is present along with the previous financial data, so it can easily compare its current performance with the previous data or previous performance. Again, this method, there can be positive changes and negative changes as well. So just assume if a company significant increase in the net income or a significant increase in the sales, these all can be the positive changes when it's comparing to previous year or previous period. Again, there can be some negative signs also, like a large percentage increase in account receivable or inventory is related sale might signal problem with the collection effort and potential obsolescence. Again, if an expense category is increased a lot compared to previous year, it's a negative sign. So by doing this comparative or horizontal analysis, the financial statement can be compared with the previous performance, and we can get the positive changes. What are the positive changes compared to previous year performance? And we can get a negative or warning sign from the comparative statement analysis. So here you can see a comparative income statement. This is a comparative income statement. You can see this is the current year 2024, and this is the previous year. So all this data, including sales, cost of goods sold, gross profit, operating expense, and net income, all these we can compare with the previous year or 2023, and we can see the absolute changes in dollar value and percentage changes also. So here you can see the sales, it's increased $150,000. That means 30% when it's compared to previous year. Again, when it's come to cost of goods sold, there is a 150,000 increase. Sorry, 90,000 increase. Again, it's 30% change. So when it's come to gross profit, there is an increase of $60,000, and it changes a positive change of 30%. Here we can see that the operating expenses is increased 30%, which is only 20% compared to previous year. 20% change or 20% increase compared to previous year. So as a result, we can see that the gross profit is increased $30,000. That means 60%. So what we can interpret from this example, while sales and gross cost of goods sold grow proportionally, the slow growth in the operating expenses is only 20% lead to higher growth in net income, indicating strong control over fixed cost as the business scale. So in this analysis, what we can understand that is this business grown and the sales all grown 30%, but when it's come to operating expenses only grown 20%. So that means this business is successfully managed its operating expenses when it's compared to is scaling up. So the comparative financial statement analysis will help the analysis like this. We can compare the current year performance with the previous year or multiple years performance and to see the trend, how the revenue is growing, how the cost of goods sold is moving, how the gross profit is moving, again how the operating expense is moving, and also how the net income is moving. The same thing, the same comparative analysis we can do with the balance sheet also to see how each balance sheet items like current asset, fixed asset, current liability, long-term liability, equity. By this comparative analysis, we can see all balance sheet item, how it is fluctuating, how it is moving year to year, and we can see and interpret a trend of its financial performance by making a comparative balance sheet. So the comparative analysis is one category of analysis in the financial statement analysis. So we'll move into our next category of analysis, that is vertical or common sales financial statement analysis. The vertical or common sales financial statement analysis is express every line item in the financial statement as a percentage of single chosen base figure within the same period. So in the comparative analysis, what we told, we are preparing the financial statement or we are comparing the financial statement with the previous year performance. But when it comes to common sales or vertical income statement or vertical financial statement, it is expressing an item of financial statement as 100% and all other item of the income statement or of the balance sheet expressing as a percentage of this item. So when it comes to income statement, every item expressed as a percentage of net sales. Again, when it comes to balance sheet, every item expressed as a percentage of total asset. So how, when it comes to income statement, what we can say, the sales or the gross profit is the 20% of sales. Net profit is 10% of sales. So we can analyze the financial statement like this. All the income statement item expressing as a percentage of net sales or the cost of goods sold is 60% of total sales. So this is vertical or common sales analysis. Again, when it's come to balance sheet, our current asset is total 25% of total asset, and our equity is 50% of total asset. So by vertical analysis, it is expressing all item or every item expressed as a percentage of net sales when it's come to income statement, and also percentage of total asset when it's come to balance sheet. So the vertical or common sales financial statement is a powerful tool for interfirm comparison and intra-firm trend analysis, analyzing internal cost structure over a period of time. So we can compare our comparative vertical financial statement with the other companies or industry benchmark financial statement, and also we can use our internal analysis, internal cost structure, how it is moving over a period of time. The interfirm is allow comparison between a small company and a massive multinational corporation by normalizing different sizes, because all expenses or all the categories are expressing as a percentage of single item. So we can compare the companies with the different operating level or different sales level. We can compare the income statement or balance sheet with a different operational level. Again, intra-firm comparison, when it comes to intra-firm comparison, the cost of goods sold or the operating profit or the net profit, everything can express as a percentage of sales when it comes to income statement. The same time, when it comes to balance sheet, the current asset, current liability, long-term asset, everything can express as a percentage of total asset. So if it comes to income statement, it can be an immediate flag of what is our cost of goods sold ratio, what is our GP ratio, what is our operating profit ratio, what is our tax percent compared to net sales, what is the net profit ratio. So all this can be expressed as a percentage of net sales. So here is an example of a common sales balance sheet. You can see the all total asset is expressed as 100% and total liabilities and equities is so the same time the total liabilities and equities are also expressed as 100%. So in this case the current asset is 30% and fixed asset is 70% and the current liabilities are 20%, long term debt 30%, equity 50%. So by using this analysis we can see our financial statement or financial position. So we can say that 30% of our total assets are current asset and 70% of total assets are fixed asset. Again, when it's come to current liability, 20% of our current liabilities are current liability, 20% of our liability current 20% of total asset is current liability. Again, 20% of long term debt, total asset is long term debt, and 50% of our total asset is the equity. So everything is expressing as a percent of total asset. So we'll move to next category of analysis, that is horizontal analysis, trend or index number analysis. So what we discussed now the comparative income statement that we already covered and the vertical or common size income statement that we already covered. Now we are moving to horizontal trend or index number analysis. This is an extension of comparative analysis over many periods, tracking changes related to a single base year. The data converted into an index number where the base year is always set to 100%. So the horizontal or index or trend analysis is a powerful tool to track the performance of the financial statement for multiple periods. So in the trend analysis, the base year set as 100%, all the values of base year will set as 100% and the corresponding years as expressing as a percentage of base year. So you can see the index analysis here. Here is the sale of a company for 2021, 22, 23 and 24. Here you can see the base year set as 100%, that is 2021, and 2022 is 110%. That means there is a 10% increase here. And again the 2023 value is comparing with the 2025 value. So there is a growth of 125%. Again, when it's come to 2024, there is a $200,000 growth. That means is the 150% of 2021 sales. So the base year value set as 100% and all the corresponding years value is expressing as a percentage of base year value. So what we can interpret that while the sales grow constantly, the growth rate is accelerate significantly between 2023 and 24. Again, the suggesting successful new project launch or a market expansion in the later period. So what we can interpret that when it's come to previous period or previous year, the sales has grown rapidly. We can see this from this example. So how we can easily interpret that the how much percent when it's compared to base year. 2022 expressing as a percentage of base year, this base year. 2023 also expressing as a percentage of base year. 2024 also expressing as a percentage of base year. So in the index or trend analysis, every value of income statement or a financial statement is expressing a base year value expressing as a 100% and the corresponding year's value expressing as a percentage of the base year value. So we already discussed different type of financial statement analysis now, the comparative financial statement analysis, horizontal analysis and vertical analysis. So comparative financial statement we already discussed, expressing or comparing a company's current financial data or financial statement with the previous year's financial statement. Again, the vertical analysis expressing one value of the income statement or one value of balance sheet as 100% and all other value expressing as a 100% of this value. That means when it's come to income statement or the profit and loss account, sales is expressing as 100%. Again, when it's come to balance sheet, total asset is expressing as 100%. Again, the horizontal or trend analysis, the base year value is expressing as a percent or as a 100%. Again, when it comes to horizontal or trend analysis, the base year value is expressing as 100%, and all other corresponding financial statement values are expressing as a percentage of base year value. So, let's move into the final topic of this discussion, that is limitations of financial statement analysis. Again, there are financial statement analysis is a powerful tool to assess or to analyze different financial statement, its performance and its profitability. There are some limitations also related to financial statement analysis. So it is very crucial to understand the limitations when interpreting the financial results. So the first important financial limitation is accounting methods. As we know, there are different methods, accounting methods are there, like in depreciation or inventory costing and revenue recognitions. So if you are comparing two companies which are using two different accounting method or accounting standards, can make difficult in comparing or effective comparison of financial statement. So just assume if two companies are using different depreciation method, so its profit can be vary, its performance can be vary by its own books of account. So if you are comparing these two financial statements, you have to see which accounting method or which depreciation method is used by this company before going into a final interpretation. So the first limitation is obviously it's the accounting method which is using, which has to be two companies are using different accounting methods, so the interpretation might not be 100% meaningful. So the next limitation is non-financial factors. So there are a lot of non-financial factors like management quality, employment morale, brand reputation, and macroeconomic condition. So there are a lot of factors which are going to affect a company's future performance. In the financial statement analysis, we are completely ignoring these factors, and so it can be, though this is a limitation of financial statement analysis, the non-financial factors are not considering into financial statement analysis. Again, the inflation and price level changes. So if we are doing a trend analysis, sometimes we will notify that there is a positive change in the sales, but it might not be efficiently or 100% the sales volume growth. It can be sometimes it can be the inflation rate or changes in the inflation level. So this inflation and price level changes has to be considered when we are doing a trend, especially when we are doing a comparison with the past financial performance with the current financial performance. The first limitation, the next limitation, what we can say is industry specificity. Again, there are different benchmark for different industries, and there can be different industry or different benchmark for different companies also, even if it is in the same industry, depending on its operating structure, its management stage. So the direct comparison between two companies, before we are doing a direct comparison between two companies, these factors has to be considered. So which companies, what is in both companies are industry benchmark, or what are the management preferences, these factors has to be considered while we are doing a financial statement analysis. So what we discussed today is the financial statement analysis, horizontal analysis, vertical analysis, and the limitations of financial statement analysis. Also the comparative financial statement analysis. Again, I am attaching this study material for your reference. You can download this material in the link in the description. Thank you for watching this video.